Hello, this is Dr. Seitz, and today we're going to do a couple of problems over some transactions where we are having to deal with accounts payable and accounts receivable and updating for supplies expense. So we'll go ahead and get started. All right, the problem we're going to start with here is on December 31st, year one of Smith's Company accounting record. Show the following account balances: cash for 1,000, common stock for 900, retained earnings for 100. During year two, Smith paid 500 cash to purchase office supplies, and they earned cash revenue. On December 31st of year two, they counted the supplies, and so they did an inventory and determined out of the $500 cash that they used to purchase supplies, only 200 was left. Based on this information, determine the amount of net income reported on year one of the income statement. All right, so assuming that you have that information handy, I won't be switching back and forth to the different screens here. I'm going to pop over here to my work paper and begin to start writing on the problem here. So the first thing that I need to do is identify 3 transactions that were described in the description above. So the very first thing that I notice is that we paid $500 for supplies. That's the first thing I notice. We earned revenue, so we earned $800 in revenue, and that we recognize that there was an expense. So at the end of the year, if you remember, we went and we counted the supplies, and there were $200 left of the supplies. So at the inventory count equaled $200. And so if we had $500 to begin with, so if our beginning balance was $500 that we purchased for supplies, which is right here, we had $200 left, okay, that must mean that we used $300. And so whenever I think of used, I think of the word expense. So here we can say that we used, or we had supplies expense of $300. So that's the very first part. So B says record the beginning balances in the 3 transactions in this horizontal financial statement. So here we have the beginning balance of cash that was given in the problem of $1,000. Supplies was 0. Common stock was $900. Beginning balance of retained earning was $100. There were no beginning balances here. Okay. And then we're going to record those 3 transactions. So you notice 1, 2, 3 right here. So the 3 transactions is we paid $500 for supplies. So I'm going to decrease my cash account by $500. I'm going to increase my supplies account by $500. So I'm just basically doing an asset exchange there by increasing supplies and decreasing cash. There is no effect on the income statement, but what we do see here is that there's a $500 decrease to operating activities for the statement of cash flows. We earned $800 of cash revenue, so they paid us $800. I'm going to increase my cash by $800, and I'm going to increase my retained earnings because I had an increase in revenue over here for $800, no expenses for that transaction, and an increase in net income, an increase in cash for operating activities. And then finally, we're going to recognize this $300 expense. So I'm going to decrease my supplies by $300. I must have used $300 of an expense. An expense also decreases retained earnings. And I'm going to put that out here so we can see why that's not in parentheses there, and show a decrease there. But that does not affect the cash flow. That does not affect the cash flow because notice no cash exchanged hands. And then finally, it says prepare a balance sheet, income statement, and statement of changes in stockholders' equity. So we have here part C of this particular problem. The revenue that we received from up above was $800. Our expenses that we used was $300, not just cash expenses. It's not just cash expenses, okay, because we used $300 worth of supplies. We had a beginning balance, we went and took an inventory, and now we only have $200. Beginning retained earnings was given at $500. Net income drops down here. I'm sorry, beginning retained earnings was $100. net income of $500. There were no dividends paid out, so my ending retained earnings would be $600. My beginning common stock was 900 given in the problem. I didn't issue any, so my ending common stock would be 900. So beginning retained earnings, this number here plus 900 here equals my ending stockholders' equity of 1,500. Now at the end of the time period, we have an ending cash balance. You notice up here, I didn't do the math, but if you were to prepare an ending cash balance, you would see that the ending cash balance would be 1,300. Our supplies based on our inventory was 200, and that gives me total assets of 1,500. I don't owe any money. My stockholders' equity from up above here, would be common stock of 900 and an ending retained earnings of 600. So our total liabilities and stockholders' equity, 1,500. These two balance. Yay! I can move on. Cash flow from customers, I received 800 in services, and purchases supplies is out. So I show a $300 net cash outflow or inflow from activities. There was no investing activities. I had no financing activities. So our net change in cash will be 300. I had a beginning cash balance of 1,000, which was given in the problem, and actually is even all the way up here. We had this beginning cash balance of 1,000, and therefore that equals my ending cash balance of 1,300. That ending cash balance, just to do a double check, does in fact equal my ending cash balance here, so I'm good to go. All right, that's all for this problem where we're updating supplies and recording the what would be called an adjusting journal entry. So the original journal entry, even though we haven't gotten to the debits and credits, the original transaction would be transaction 1, and then the adjusting entry, the ADJ is what I'm going to call them, would be transaction 3. Let me know if you have any questions.